There is an entire financial system you will never see on the news. It is hidden, and it operates where trillions flow beyond government oversight, directed from closed rooms in Basel and from secret islands across the world. Shadow banks and offshore networks decide who prospers and who falls. This quiet machinery shapes every paycheck, every crisis, and every lost home. Most people have no idea it exists. But how does this secret system really control our lives? In the 1970s, a quiet revolution began in global finance. Regulators loosened rules, and new financial players stepped into the shadows, operating outside the reach of traditional banking laws. This world became known simply as shadow banking. Unlike ordinary banks, these entities do not take deposits or offer checking accounts. Instead, they create and move trillions through complex arrangements, including money market funds, repurchase agreements, and asset-backed commercial paper. Shadow banking grew rapidly because it promised higher returns and fewer restrictions. Investment funds, finance companies, and securities dealers designed new ways to lend and borrow, using assets like mortgages and corporate debt as collateral. By the early 2000s, these conduits were moving vast sums, often with little public scrutiny. The Financial Stability Board estimates that by 2023, non-bank financial institutions accounted for nearly half of all global financial assets, up from 43% in 2008. The machinery behind this growth is intricate. Asset-backed commercial paper let companies raise short-term cash by selling debt tied to pools of loans. Money market funds offered investors the safety of cash with slightly higher yields, but without the protections of bank insurance. Repurchase agreements, short-term loans backed by securities, became the lifeblood of day-to-day funding for large institutions. Each of these instruments bypassed the strict oversight that kept banks in check. As a result, credit could expand far beyond the limits set by central banks and regulators. The shadow banking system became a hidden engine, fueling booms, amplifying risks, and operating in the gray zones of finance, where transparency is scarce and accountability is often optional. At the heart of the global financial system sits a quiet institution now in Basel, Switzerland, the Bank for International Settlements. This is where the world's major central banks meet, far from the public eye, to coordinate policy and manage risk. The BIS acts as a hub for coordination, but its most powerful tools are rarely discussed outside specialist circles. Among these tools are standing liquidity facilities, permanent arrangements that let select central banks access emergency funds whenever needed. These facilities are a form of invisible insurance for the financial elite. In October 2013, the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Bank of Canada, and the Swiss National Bank established permanent, unlimited swap lines. These agreements allow each institution to draw dollars or other major currencies on demand, with no set limit. The arrangement is not open to every country, and it creates a clear hierarchy. Those inside the network enjoy immediate, backdoor access to the world's reserve currency during times of stress. Those outside must wait, negotiate, or rely on more restrictive channels. When a crisis hits and dollar funding dries up, the mechanics are straightforward on paper. A central bank in the network can request dollars from the Federal Reserve. In exchange, it posts its own currency as collateral. The dollars then flow to banks and institutions in its home country, stabilizing markets before panic spreads. This is not designed for day-to-day use. It is reserved for moments of acute strain. These facilities are priced above normal market rates, so they are not used in ordinary times. Yet their existence functions as a safety net, quietly supporting the financial system's upper tier. The public rarely hears about these arrangements. They stand ready, unseen, but always present, waiting for the next shock. A different kind of invisibility cloaks the world's wealth. In places like the Cayman Islands, the British Virgin Islands, and Panama, financial secrecy is not an accident. It is by design. These jurisdictions offer a simple promise. Register your company here and your name disappears from public records. The true owner, the person who actually controls the money, remains hidden behind layers of nominees, shell companies, and legal trusts. This system depends on a global network of intermediaries. Lawyers, accountants, and corporate service providers set up thousands of companies every year, each one a new layer of concealment. A single shell company might own a bank account in Switzerland. That company in turn is owned by a trust in Jersey or Guernsey. Tracing the real owner becomes almost impossible, even for law enforcement. The scale is staggering. The Tax Justice Network estimates that as much as $32 trillion sits offshore, outside the reach of tax authorities and public scrutiny. In many of these jurisdictions, beneficial ownership laws either do not exist or are so weak that they order little more than a paper trail to nowhere. This opacity is not limited to billionaires or global corporations. It is routine business for the world's wealthiest, and the infrastructure to hide ownership is available to anyone who can pay for it. The result is a parallel financial universe, one where rules are different, oversight is minimal, and accountability is almost non-existent. On September 16, 2008, the Reserve Primary Fund broke the buck. For the first time in decades, a major money market fund fell below its $1 per share value, shattering the illusion of safety for millions of investors. Overnight, $62.5 billion in assets became a source of panic. As redemptions surged, the fund's exposure to Lehman Brothers debt triggered a chain reaction. Within days, over $100 billion fled from money market funds across the industry. Companies that relied on these funds to finance day-to-day operations suddenly found credit lines frozen. The federal government stepped in to stop the bleeding, but the damage rippled out. Workers lost jobs, businesses shuttered, and families watched retirement savings evaporate. 8 years later, another shock arrived, not through markets, but through a leak. In 2016, the Panama Papers exposed 11.5 million files from Mossack Fonseca, a law firm at the heart of the offshore world. The documents revealed a network of shell companies and secret accounts, shielding wealth for politicians, billionaires, and criminals alike. The scale was staggering. More than 200,000 offshore entities were hidden from tax authorities and the public. The leak made clear that financial secrecy was not an accident, but an industry, with lawyers and bankers as architects. For those far from boardrooms and offshore havens, the consequences are deeply personal. In Greece, years of International Monetary Fund-led austerity slashed pension incomes by nearly 30%. One pensioner who had worked 4 decades on the docks now counts every euro. His story is shared by millions. Ordinary people pay the price for decisions made in distant capitals and in hidden accounts. Behind the numbers are lives upended, futures diminished, and a growing sense that the system serves the powerful, while the vulnerable bear the cost. The global financial system quietly sorts winners from losers. At the top, large banks, hedge funds, and multinational corporations extract fees from every transaction, often through layers of complex deals. Wealthy individuals and corporate giants use offshore networks to shrink their tax bills, moving profits far from the places where they are earned. Specialized law firms and accountants collect steady income for building and maintaining these structures. For these actors, the hidden system is a source of profit and protection. The other side of the equation looks very different. Ordinary workers, pensioners, and small businesses shoulder the costs. When profits are routed offshore, tax revenue vanishes, leaving governments with less to fund schools, hospitals, and pensions. As loopholes widen, the burden shifts downward. Public services are cut, taxes on wages rise, and safety nets weaken. The system is designed so that those with access to secrecy and scale capture the gains, while those without pay the price. A young couple sits at their kitchen table, mortgage application in hand. They fill out forms, hopeful for a fresh start. The paperwork travels from their local lender to a vast, unseen network. Within days, their loan is bundled with thousands of others and sold to a financial firm. That firm slices the mortgages into securities, which are then sold to investors around the world. Each step adds a layer of distance between the borrowers and the ultimate decision makers. When cracks appear in global credit markets, the flow of money stops suddenly. The same mortgage, once a path to stability, becomes a source of risk. The couple's lender, unable to sell off new loans or refinance existing ones, tightens standards. Adjustable rates reset higher. Payments double. The couple misses a deadline. A foreclosure notice arrives, typed, impersonal, final. Behind this moment is a chain of decisions, invisible but direct, stretching from international policy rooms to a single living room. The system's mechanics are abstract, but the outcome is painfully real. Today, over $11 trillion sits offshore, invisible to most. As technology accelerates financial secrecy, the gap between those with access and those without widens. The system remains hidden, yet its influence touches every transaction. In a world shaped by shadows, real transparency is still the rarest currency.